John Murphy is one of the leading technical analysts in the country and familiar to many people watching CNBC, and the author of some best-selling books on the subject, including Technical Analysis of the Financial Markets, The Visual Investor, and a third one, Intermarket Technical Analysis. Here's the guru. Mr. Murphy, I want to ask you one or two questions about technical analysis, particularly from the beginner's point of view. And to start with, can anyone learn technical analysis?
Oh, I think very definitely. In fact, there's kind of a misnomer or a myth about technical analysis, is that it's a very, very difficult field. You can make it difficult. It can be a very broad field. But the message that I have to investors is that you can learn some of the very simple principles of technical analysis. They're really not that difficult. There may be only about a half dozen or so principles.
I see.
You can learn them and dramatically improve your performance in the market and do very, very well without getting into all the esoteric stuff. My message is always keep it simple, learn some of the basic principles, and that should go a long way.
Now you're talking about technical tools that you can use when you're studying the market. What are some of these tools? What do you call them?
Well, the simplest tool, in fact the one that we recommend that the average investor pay a lot of attention to, would be a moving average, for example. This is one of the more popular technical indicators, and for example, the best known one is a 50-day moving average. This is where the computer, which we're using computers, goes back and takes the stock price, takes the last 50 days closing prices and divides by 50. So it's a moving average. Generally speaking, when a stock is trading above its 50-day moving average, that's a good sign. That means that the trend is up and it's a good time to buy a stock. People say, well, when's a good time to sell a stock? Well, when it goes below the 50-day moving average. And you'll find that very often, if a stock starts to run into a problem or a market, whatever, the first sign of trouble is usually it'll break below that 50-day moving average. So that's the kind of thing we try to teach people. There's some very simple rules that really don't even require a lot of interpretation that can really improve your market timing.
Now charts, of course. You use charts.
Yes.
and other special charts that you use, or other basic ones like a bar chart or a candlestick chart. Are they all good?
They are all good. In fact, more and more I try to teach people how to read charts. I mean, again, it's not that terribly difficult. There were just a few simple principles. In fact, it really comes down to, this is going to sound kind of silly in a way, overly simple, but we ask people to look at the chart and ask yourself, which way is the price going? Is it going up or is it going down? And they're pretty easy. If it's going up, you buy it or you want to own it. If it's going down, you don't want to own it. And now we refine that over and over. But that's really what it comes down to, being able to look at the chart, look at the market, and see, is something going up or is it going down?
Now you've been a pioneer in developing technical analysis and popularizing the use of technical analysis. Are there any new trends developing? Is this something that's all over and done with, or are there new things for us to learn?
Oh no, I think it's a very fertile area. In fact, I would say one of the emerging trends, and I helped develop this, I wrote a book a few years ago called Intermarket Technical Analysis, which really broadened the whole idea of technical analysis. It has to do with the fact that all of the markets are related. And it sounds like we're talking economic theory. For example, when oil prices are rising, this generally has a negative impact on the economy. And you can see this on a chart very clearly. That slows down the economy. It causes the Fed to raise interest rates and has a slowing effect on the economy. This is very good for oil stocks, but it's very bad for certain other types of stocks. What the U.S. dollar does, for example, is very important. What happens in the overseas markets are very important. And we can chart all these things and we can study the interrelationships. And it sounds like we're doing economic analysis, but we're using pure technical analysis.
I see. Is this something to do with sector analysis and sector rotation?
Very definitely. It's very much tied together. For example, in an environment where we've been in over the last several years, rising oil prices, for example, oil stocks generally do very, very well in that economic climate.
And they did.
And they have. Whereas transportation stocks are very negatively impacted by rising oil prices. They tend to go down. Also in an environment of rising oil prices, since this has a slowing effect on the economy, stocks that are tied to the economy, like retail stocks or economically sensitive stocks, tend to underperform. Whereas defensive stocks like the drug stocks and the utilities tend to do quite well. So it's all tied, very much tied in together. It's a combination of using charts, but it's backed by very sound economic theory, and I think that that's the real future of technical analysis, is being able to kind of bridge these different disciplines.
Thank you very much, John.